Before I start, I'd like to say a quick thank you to our sponsor, Fidelity International. You can find out more about them at fidelity.co.uk/money to the masses. Welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. Now, we're still seeing a lot of euphoria in equity markets. In fact, the S&P 500 in America is over 3,300. It has gone over that for the first time ever. So we've seen new all-time highs, and we've seen new all-time highs in European stocks as well. So the euphoria has spread globally, although we've seen a slight pullback this week for reasons that I'll come on to a bit later in this show. But the positive mood in markets was boosted by that phase one trade deal that was signed last week between the US and China. Now, there are, of course, some unresolved issues, including the IP theft that America accuses China of doing. There are these subsidies that China paid to their state-owned entities, the state-owned companies, and America thinks that makes it an unlevel playing field for US companies. So there's still a long way to go, and in fact, phase two discussions haven't even been tabled yet, and a lot of it probably won't even happen until after the US election in November. So there's still a lot that could possibly go wrong, but for now, the market is happy on trade. We've also seen a fairly positive start to the US earnings season. In fact, 75% of companies that have announced their earnings to date have actually beaten analysts' expectations. So that has been another reason why equity markets have felt fairly bullish. For example, Netflix announced their earnings this week, and while they generally beat analysts' expectations and their share price was fairly steady, there were concerns over the growth of their subscriber numbers in the US. Not so much globally, but particularly in the US. And in the days that have followed their earnings announcement, the stock price has fallen about 4%. But generally speaking, earnings season has been okay so far. But next week, we've got some big tech names announcing their earnings. So, for example, we've got Apple on the 28th of January, we've got Facebook and Microsoft on the 29th, and we've got Amazon on the 30th. Now, these are all going to be key numbers to look out for, because with valuations for tech stocks in particular being very lofty, we've seen a good rally in tech stocks again this new year, then the results are going to be key in determining whether those valuations are going to be overextended or actually justified. So there's something to look out for next week. But as an aside, there's been a number of companies that have started to mention inflation and concerns around that, particularly in terms of costs for the companies. And if you remember the last few episodes, that word of inflation has started to creep in. Not many people are talking about it, but there are signs that inflation could start to pick up, and if it does, that could cause problems for central banks and a lot of market assumptions. Perhaps the biggest story of this week is one that has come out of the blue, which is the coronavirus in China. Now, this is a virus that has started to spread around China. It's actually left China, and there's been cases in America and other countries. And as the news continues to leak and spread about what's going on with the virus, it started to cause slight wobbles in the stock market. If you looked early on in the week, markets pulled back, particularly in Asia. So that was obviously the area that's at the epicenter of this new crisis. Now, markets pulled back, and we're down probably about 1% if you look over in the east, so in Asia. If you go further west, then markets are pretty sanguine about the whole thing. For example, America, the stock market is still positive for the week since the last show that I made. And in Europe, it's fairly flat, even though they pulled back slightly from recent highs. As details continue to emerge over the virus, it'll be interesting to see how stock markets react. After the initial pullback, like I said, in Europe and America, they've been fairly sanguine. But today, as I make this video, in Asia, they've pulled back again. Now, what is interesting about a situation like this is if you look at individual stocks and what they do. So if you looked at some pharmaceutical companies, people who make flu jabs, you would have seen their stock prices soar on a given day. Likewise, you would have seen transport companies, we're talking about airline companies, their stock prices would have fallen as people started to fear that people wouldn't be able to travel. And if you look in China already, there are about 20 million people in quarantine where they've actually isolated particular cities. And while a lot of that has been a knee-jerk reaction, we've also started to see some of the defensive sectors globally start to outperform some of the cyclical sectors, because people are starting to worry that if there is an outbreak of a virus, it might have some temporary impact, at least, on economic growth figures. Now, of course, we have been here before. If anyone remembers the SARS outbreak, we had stock markets have a wobble back then. And there was also the MERS outbreak in the Middle East. Now, these sorts of things tend to be temporary, but it will all depend on what happens with this particular virus. And so we need to watch the news flow. But in itself, the virus outbreak is probably unlikely to be the cause of any pullback in stock markets. It's likely to be something around economic growth assumptions, as I mentioned last week. And it's interesting to keep an eye on those defensive versus cyclical sectors. You can do it if you go to barchart.com. They have some great analysis and tabs where you can look at individual sectors within the S&P 500 to see how they're performing on a day-by-day basis. You don't want to get obsessed by them, but it gives you an indication of where the market's head is at. So if you see things like utilities or REITs doing well, they're the defensive sectors, and that will give you a sign that people are maybe changing their thought on where the market's going, particularly around economic growth. Of course, the main driver of markets still is the Federal Reserve and their accommodative policy for markets. So as long as the Fed has got the markets back, there are a lot of people still piling in money. And in fact, if you look at the institutional retail investors, it looks like everybody is almost all in at this point in time. So that is it for this week on Damien's Midweek Markets. We are as we were last week, but we've got this other event that came out of nowhere that's starting to worry markets. So we need to keep an eye on the news flow. You can get hold of me as ever, Damien at moneytothemasses.com is the email address. Via Twitter, Money to the Masses with the number 2. Of course on Instagram and via Facebook.